This house has a fixed-rate mortgage. For years, the payment never moved, the same number every single month. That was the whole promise. Fixed means fixed. And for the family here, nothing about their life had changed either. Same jobs, same rooms, same routine. The only thing that moved was a number they never controlled, and a letter they never asked for. Then, one envelope showed up from the bank. Same rate, same loan. Not one word of the contract had changed, but the payment inside had jumped by a couple $100 a month. The letter was supposed to explain why. Instead, it was a wall of numbers, an escrow analysis that explained nothing. So we're going to do what the bank won't. Show you exactly how a fixed payment gets raised, where every dollar of that jump comes from, and the part they never tell you. Which piece is permanent, and which piece quietly disappears. Here's what most people don't realize. Nearly half of homeowners believe a fixed-rate payment simply cannot change. In one national survey, 45% said exactly that. They're wrong. And the gap between what they believe and what's actually in that letter is costing millions of families right now. Start with the thing almost nobody understands, even though 80% of American mortgages run on it. Your monthly payment isn't one thing, it's two. The first part is the loan itself, principal and interest. On a fixed-rate mortgage, that number really is frozen. It will not change for 30 years. Principal is the money you borrowed. Interest is the bank's cut for lending it. Together, they're the only part of the whole deal you actually locked in. Bolted onto it is a second part, an escrow account. Every month you pay extra into it, and the bank uses that money to pay two bills on your behalf: your property taxes and your homeowner's insurance. There's even a name for the whole thing: PITI, Principal, Interest, Taxes, Insurance. The first two are the loan. The last two are the escrow. And the escrow is the half that moves. You never see those two bills. You never write those checks. The bank does it quietly in the background. Convenient until one of them moves. Because when your taxes or your insurance go up, your fixed payment goes up with them. And you don't find out until the letter. So what actually moved? There are two engines behind escrow shock, and the bigger one, by far, is insurance. The average American home now costs $3,300 a year to insure. 3 years earlier, it was closer to $2,600. That's a 24% jump in 3 years. And it wasn't a few unlucky places. 95% of zip codes saw an increase. 1 in 3 rose more than 30%. In some states, it's brutal. Over 3 years, Utah's premiums rose 59%. Illinois, 50%. Arizona, 48%. Pennsylvania, 44%. This stopped being a coastal story a long time ago. Go back to 2020, and it's worse. Homeowners insurance is up more than 50%, roughly 3 times faster than property taxes over the same stretch. A Federal Reserve study put a number on it that's hard to forget. Insurance premiums rose about 70% between 2019 and 2025. Insurance used to be a rounding error on your mortgage. In 2013, it was under 8% of the average payment. Today, it's over 9%, and by the Fed's measure, closer to 14. The frozen part of your loan is being crowded out by the part that isn't. But plus 70% raises the real question. Why? Why is insuring a house that hasn't changed suddenly this expensive? Here's the answer the escrow letter will never give you. In 2024 alone, the United States was hit by 27 separate weather disasters that each caused over $1 billion in damage. The total bill? $182 billion in a single year. 568 people died. $1 billion disaster now hits the country roughly every 2 weeks. That made 2024 the 4th costliest year on record, and the second most of these disasters ever counted in a single year. And 2024 wasn't a freak. Over the last 5 years, these billion-dollar disasters cost $746 billion, more than double the long-run average. Insurers pay for those losses. Then they buy their own insurance, reinsurance, and that price soared too. Add building materials, up around 15% in a year, and rebuilding your exact house costs more. And it's gotten bad enough that in the hardest-hit states, major insurers have pulled back, writing fewer new policies, or leaving altogether. Fewer choices means less competition, which means the price you're quoted climbs even higher. All of it. Every hurricane, every rebuild, every reinsurance contract flows downhill, through your insurer, into your premium, into your escrow, and out as a higher monthly payment. You are the last link in that chain. Nowhere shows it like Florida. The average Florida homeowner now pays $8,292 a year to insure a home. That is 181% above the national average. Same country, same coverage, nearly triple the cost, because of where the storms land. Compare Vermont, where the average is about $1,100. Florida premiums rose almost 50% from 2020 to 2025, outpacing inflation and income growth. Your zip code is now a bigger factor in your mortgage than your interest rate. Now, the second engine, property taxes. Smaller, slower, but relentless, and always moving one direction. The average tax bill on a single-family home hit $4,300 in 2024, up 5.8% in a single year. Why? Home values jumped, up more than 8%, and your assessment follows the value. Higher value, higher tax, higher escrow. And where you live decides how hard it hits. In New Jersey, the average bill tops $10,000 a year. In Illinois, the effective rate hits 1.75%, the highest in the country. And New Jersey isn't alone. Connecticut averages over $8,600, New Hampshire and Massachusetts near $8,000. New York just behind. Nationwide, single-family homes were billed $382 billion in property tax in a single year, up more than 5%. Stack both engines and you get a record. The average total mortgage payment just hit an all-time high, $2,070 a month. And on older loans, more than a third of that now goes to the two things that keep moving: taxes and insurance. So the fixed part of your mortgage is real. It's just a shrinking island in a rising sea. Which brings us to the mechanism, how that rising sea becomes one shocking letter. Everything the bank does with your escrow is governed by one federal rule. RESPA, Regulation X, Section 1024.17. It's public. You can read it. And it says the bank must recheck your escrow account once a year and mail you the result within 30 days. That once-a-year recheck is the annual escrow analysis. It's not cruelty. It's the bank being legally required to true up your account to reality. But that true-up is where the jump is born. And it hits you twice. Hit 1. The reprice. The bank takes your new, higher taxes and insurance and recalculates what your monthly escrow should be going forward. That increase is permanent. It's simply the new cost of the two bills. Hit 2. The shortage. For the past year, you paid in based on last year's lower numbers, while the bank paid out this year's higher ones. Your account ran short. The law lets the bank recover that gap by spreading it over the next 12 months. And timing decides how deep the hole is. If the big bill hit early in your escrow year, your account bled for months before the analysis caught it. So your shortage is larger and your catch-up steeper than a neighbor whose bill landed late. Same increase, different letter, purely because of the calendar. Let's build a real one, line by line. Property taxes, from $4,064 up to $4,300. Homeowners insurance, from $2,655 up to $3,303. Add them, divide by 12. Your base monthly escrow rises from $560 to $634. That's $74 a month more. And that part never goes away. Now the shortage. The national average right now is $2,157. Spread over 12 months, it adds another $180 a month. 74 plus 180. There's your letter. A jump of about $254 a month. That's not a rate change. Your interest rate never moved an inch. And $250 a month is $3,000 a year. A used car payment, bolted onto a mortgage you thought was locked. And here's the answer we promised at the start. That 180 is temporary, a 12-month catch-up. Once it's paid off, if nothing else rises, your payment falls back to about $74 over the old one. So of a $250 shock, only about $74 is the real, permanent increase. The rest is the bank collecting last year's difference. Nobody tells you that, so people budget for the wrong number and panic. Now watch the same math in a high-cost state. A Florida homeowner isn't paying $2,700 for insurance. They're paying over $8,000. That alone is nearly $700 a month in escrow, just for insurance before a single tax dollar. So when Florida insurance jumps again, the shortage isn't $2,000, it can be double that, and the monthly hit lands far harder. Same letter, same law, triple the damage. Your escrow shock is only as big as your risk map. One more thing the bank is allowed to do. On top of everything, it can hold a cushion, a reserve. But the law caps it at 2 months of escrow. Not 6, not a year, 2. On a $600 escrow, that's about $1,200, no more. And if the account actually goes negative, a deficiency, the rules tighten. The bank can pull that back over as little as 2 months, not 12. The deeper the hole, the faster they empty it, and the harder the short-term hit. And it cuts both ways. If your taxes or insurance ever fall, the same analysis runs in reverse, and any surplus over $50 must be mailed back to you within 30 days. Escrow isn't a one-way ratchet. Lately, everything underneath it just points up. Now zoom out, because this is not rare bad luck. It's happening to most of the country at once. Analysts estimate as many as 65% of homeowners with escrow are facing a shortage right now, averaging that same $2,157. Nearly 7 in 10 say their payment already went up in the last 2 years. Read that again. Not a slice, not a fraction. Most homeowners with an escrow account, all at the same time. And most never saw it coming. 55% said the increase caught them by surprise. Only 60% say they even understand how escrow works, a number that's falling, not rising. Remember the 45% who believe a fixed payment can't change? This is the bill for that belief. What you don't understand about your own mortgage, you cannot plan for. And for some families, it's more than budgeting. The same Federal Reserve research found that insurance-driven payment jumps pushed roughly 31,000 mortgages into delinquency in a single year. People falling behind not because their loan changed, but because their escrow did. Think about that. Not a job loss, not a rate reset. A bill they never negotiated, quietly pushing families past the edge of what they can pay. And researchers project that as premiums keep climbing, that number could grow by 200,000 mortgages a year. This is the quiet edge of a housing problem almost nobody is naming. The strain is showing in how people think about home. In that same survey, nearly half said they'd consider selling if taxes kept climbing, and more than a quarter would think about moving over insurance alone. The forever home is quietly becoming a spreadsheet. It starts as one letter on one kitchen table. Multiply it by tens of millions of escrow accounts, and you're looking at one of the largest silent increases in the cost of owning a home in a generation. So who's getting rich off this? The honest answer is uncomfortable. Mostly, nobody you can sue. Your escrow payment is a pass-through. The servicer doesn't keep your taxes. Those go to your county. It doesn't keep your premium. That goes to your insurer. When your escrow jumps, the bank isn't pocketing the difference. What the bank does get is the cushion. 2 months of reserve, held across millions of accounts, is a lot of other people's money sitting in its hands. But RESPA caps it, and surpluses over $50 must be refunded. The account itself is regulated fairly tightly. And here's the part I have to be straight with you about. Escrow is not a scam. It protects you as much as the bank. It stops a forgotten tax bill from becoming a lien that takes your house. It stops your insurance from lapsing the month before a fire. Both of those are catastrophes the escrow account is built to prevent. And for millions of people, silently, it does exactly that every year. The real villain isn't the account. It's the cost underneath it. Insurance repricing a warmer, more expensive country, and taxes tracking home values that ran away from wages. The letter is just the messenger, which is why this won't stop on its own. Insurance is in its 5th straight year of increases. Disasters trend up, not down. Home values sit near records. Every one of those feeds your escrow. Escrow shock isn't a glitch anymore. It's a feature of owning a home this decade. The forces behind it are structural, not seasonal, and structural problems don't ease on their own. So what do you actually do? You can't stop a hurricane, but you have more control over this letter than the bank lets on. 5 moves, and before any of them, learn to read the letter itself. 3 lines decide everything: your new monthly escrow, your shortage amount, and the date the higher payment starts. Find those 3, and the wall of numbers turns into a decision. 1. If you can, pay the shortage as a lump sum. The moment you clear it, that $180 catch-up vanishes, and your payment drops to the permanent number. You owe it either way, but you kill the 12-month markup instantly. 2. Shop your insurance every year. It's the biggest lever because it's the biggest driver. Raise your deductible, bundle, requote. A better policy lowers the exact number inflating your escrow. Even a few $100s off the premium compounds, because it also lowers next year's base, and the shortage built on top of it. 3. Appeal your tax assessment. If your county's value outran comparable homes on your street, you may be overpaying, and a successful appeal lowers the tax half of the equation for years, not just once. 4. If you have at least 20% equity, many lenders let you waive escrow and pay the 2 bills yourself. That hands you the cash flow control and the full discipline and risk of covering them on time. A real option, not a free one. 5. Treat the eased payment as a floor, not a ceiling. Once your catch-up clears, don't spend that money. Next year's analysis is already coming, and insurance is still climbing. Bank the difference before the next letter does. Because that's what this letter really is, once you strip away the wall of numbers. Not a rate change, not a mistake. A repricing of a house that got more expensive to own, plus a 1-year catch-up for a bill you never saw. It's the cost of a promise the housing market quietly stopped keeping. That fixed would mean fixed. The bank will send it again next year. The only real question is how big the next one is, and whether you'll be the person who opened it already knowing what it meant. Fixed was never the whole story. Now you've read the rest of it.